Plaza de Nicaragua. So, while I'm cutting this, I have some things to say. I already got it. I would like to start with thanking Phil, aka Excelsior7 at Excelsior7 for the $5 donation on Buy Me a Coffee. Thank you, man. I really appreciate it. You're helping the channel grow. I would greatly appreciate a comment, a like, or a subscribe, only if you like my content. Let me light this one up. Also, let me know if you would like me to do a Q&A in the future. Gotta finish it with the matches. So today we will talk about stocks and investing in general. Let's start with the main topics of investing and why it's more important to put your money in stocks rather than keeping it in the bank and letting inflation eating it up. So, understanding inflation. Inflation is the gradual increase in the prices of goods and services over time. Which effectively decrease the purchasing power of your money. To put simply, the amount of money you had last year can buy you less today because of inflation. And as you may well know, that's never a good thing. So, how inflation works. For example, if the inflation rate is 3%, something that cost $100 today will cost $103 next year. So if you keep your money in the bank without earning a high enough interest rate to outpace inflation, you're effectively, literally losing money. So do the $100 times 10 is $1,000, plus the 3% inflation is $30. So the higher the number, the more you will feel it. Now, the impact on savings. Keeping money in a traditional savings account, which offers low interest rates, means that your savings are growing at a lower rate than inflation. This results in a decrease in the real value of your money over time. So if the, let's say, interest is 1 or 1.5%, and the inflation is 3 or 4%, you're losing 1.5% on your savings account. While the average S&P return, which is like an ETF, or there is an ETF for S&P 500, it's like the yearly average is I think 10%. So instead of losing money, you're making money. So if you invest $100 and the average return is 10%, at the end of the year you have $110. Now, let me explain a bit about ETFs. So, like I said, let's talk about ETFs or exchange traded funds, which ETF stands for. Our preferred investment vehicle for many. What are ETFs? You may question. ETFs are investment funds that are traded on stock exchanges. Much like individual stocks, they hold a collective assets such as stocks, bonds, or commodities, and typically track an index. You can see it as a basket of stocks instead of investing in one. The benefits of ETFs is diversification. By investing in an ETF, you're buying a small piece of a large number of stocks or other assets, which spread out your risk. Like if you invest in one stock, let's say, I don't know, Coca-Cola. Now this is a bad example because Coca-Cola won't go bust, but if the company goes bankrupt, you lose your investment. But investing in an ETF, you're basically like the S&P 500. You are investing in the 500 richest companies, biggest companies, and if one, let's say the 500 least profitable company falls out, they just replace it with the one that comes after that. Another benefit, lower costs. ETFs generally have a lower expense ratio compared to a mutual fund. Also, the liquidity. Since ETFs trade on stock exchanges, they can be bought and sold throughout the trading day at the market price, which not every option you have in trading can do. Now, there are several types of ETFs, and I encourage you to look up which are the best and most widely used. But you have like index ETFs. They track a specific index, like the S&P 500. You have sector ETFs. These focus on particularly industries such as technology or healthcare. You have bond ETFs. So that's like you invest in a portfolio of bonds, which I do not really know a lot about. I know in America they invest a pretty large amount in bonds. You use that tactic of 60-40 or something like that, or 40-60. So 40% in stocks and 60% in bonds, or the other way around. I'm not sure. Then you have commodity ETFs. So invest in commodities like gold or oil or grain and stuff like that. But to be honest, I only invest in the S&P 500 and like when it comes to ETFs, it's S&P 500. shares world. So like what, I don't know how to say it in English. Like the first world countries, economies. And there was another one, but I don't remember it exactly. But it's all like the most bought and most old ETFs that they sell at my brokerage account. Speaking about the brokerage, how to invest in ETFs. You will need a brokerage account to buy ETFs, and if you're new to investing, a lot of people also don't even know what a brokerage is. And that's basically the party at which you buy the ETF. So I use the Giro or the Gyro, I don't know how I would say it in English, but there are brokerages like Peter Pan and other ones which I don't remember the names of, but there are a lot of brokerages, and I advise you to look it up. You can also invest through your bank in the stocks and ETFs as far as I know, but I advise you to choose the most cost-effective option. Now, to research and select ETFs, you look for ETFs that match your investment goal and risk tolerance. You have uncountable numbers of ETFs, but my advice is to just go to your brokerage and you have an option to see which ETFs are most bought and longest held by buyers. And my advice is not to go too deep and just buy those. And at last, you place your order, decide how many shares you want to buy, and place your order through your brokerage. That's what I do every month. Because you pay, like I pay, I think €1 for every transaction. So it's just, what I do is I just buy a bunch of shares and pay €1 for, let's say, 10 ETFs. But if you buy them separately, so one today, one tomorrow, every purchase you pay €1. So I just combine everything and pay €1 for it. In investing, there are also high-risk stock investing options like calls and options, which, if you don't want to risk your wealth and health, I would not do, because while ETFs are a safer bet for most investors, there are other high-risk stock investments like calls and options. Options are contracts that give you the right but not the obligation to buy or sell a stock at a set price before a certain date. Which that in itself blows my mind already. So you have a call option that gives you the right to buy a stock at a specific price, and you have a put option that gives you the right to sell a stock at a specific price. And the reason they're risky is the complexity. Like, options are more complex than stocks and require a good understanding of how they work. There's a leverage, like the options allow you to control more shares for smaller amounts of money, which can lead to large gains but also large losses. Because because of, let's say, time decay, options have an expiration date and their value can decrease over time, especially if the stock price doesn't move in the direction you anticipated. That's why the only people who should consider options are experienced investors who are comfortable with the risks and complexities. And I'm not one of them, to be honest. I do have a fair share of knowledge when it comes to stocks, but I stay away from calls and options. Another interesting way to invest, although a lot of people say that it's not really investing, is gold. But I see it more as a hedge against inflation, what a lot of people call it. Gold has been considered a safe haven investment for centuries, especially during times of economic uncertainty. Why you could or should invest in gold is, like I said, a hedge against inflation. Gold tends to hold its value over time, making it a good way to fight against inflation. Like if you bought an ounce of gold last year, this year you would make $300 on it. So you can say what you want, but that's not bad. Making $300 on something that you just bought and laid somewhere in a vault, or because of safety reasons, you can buy it on like a stock on paper. But if you don't own it, it ain't yours, in my opinion. It's also during economic downturns or market volatility, investors often turn to gold as a store of value. Let's say if you live in a country that has a great instability, let me say it that way, gold has the same price everywhere on earth, so your money of your country might not have the same value everywhere on earth, especially when as it hits the fan. That's why if you have 100 grams of gold, which is I don't know, $7,000-8,000, if you manage to take that with you to the country that you're fleeing to, you have $7,000-8,000, and that's, in some countries, that's like a year worth of apartment costs. So yeah, the ways of investing in gold is you can buy physical gold. So buying physical gold in the form of bars, coins, or jewelry. Although I would never advise you to buy it in jewelry, because you pay 200 or 300% extra above the spot price just because it's jewelry. So that's idiotic. Then you have gold ETFs. So these funds track the price of gold and are traded on stock exchanges. And gold mining stocks, so investing in companies that mine gold. The risks of investing in gold is if you buy it physically, the storage and insurance costs. So physical gold requires secure storage and insurance. And I don't know if it's worth it. Either you run the risk of keeping it at home, or you have to pay keep it at a vault at the bank or somewhere else. Let me wait for the vacation plane to fly over. So, also, unlike stocks and bonds, gold doesn't produce dividends or interest, so the only thing you see going up is the value, but you don't get any dividends or interests on it, which is a shame. So you're not really making money with money. For the next part, I would say invest only what you can afford to lose. One of the golden rules of investing is to only invest money that you can afford to lose. This is important because investing always carries some level of risk, and you don't want to find yourself in a financial crisis because you invested money that you needed for essential expenses. So, borrowing money to invest it is, in my opinion, unless you're 100% certain, which you cannot ever be, the craziest thing you can do. What I like to do is set a budget. So you assess your finances, take a close look at your income, expenses and savings. Then you determine your risk tolerance. So based on your financial situation and personal comfort with risk, decide how much money you can invest. Stick to your plan. So consistently invest within your budget, whether it's $50 a month, 500 or 5,000 per month. As long as you can consistently invest it. So investing $500 or euros once in your life won't make you a millionaire at the end of your working years. You have to do it consistently. So you start small and you grow. It's perfectly fine to start with small investments and increase them as your financial situation improves. That's also logical, there aren't many people that can start with $1 million and invest it. Now I got new glasses and they're a bit loose, so they keep falling down. So if you see me pushing them back on my nose like a nerd, you know why that is. So, for the next part, and one of the most important parts, is investing in yourself. In my opinion, the best investment you can make. Because, first of all, education and skills, like continuously improving your knowledge and skills, can lead to higher income and better career opportunities. Take courses, enroll in courses related to your field of interest, because you can use that on your CV and in talks that you have with your boss. Read books, like books on personal finance, investing, self-improvement, can provide valuable insights, but trust me, don't fall for the trap of self-improvement books and stuff like that, because that's all theory, and half of that you already know. Also, health and well-being. Maintaining good health is crucial for long-term success and happiness. So you should, what I always say, exercise regularly. Physical fitness boosts your energy and productivity. But also, of course, more goals. Establish short-term and long-term goals for personal growth. Like, write it down. Just write it down. Trust me, it will help you. You should learn new skills, whether it's a new language, a hobby, or professional skill. Continuous learning is key. I know you probably never liked school or learning, but trust me, there's a saying, the more you know, the less you know. But I don't know if I agree with that, because the more you know means you are finding out things, and it also means you can find out things in which you feel the happiest, in which you make the most money, or if you don't want to make a lot of money, the more you know, the more you can find a job which makes you happy, maybe with a lesser pay, but more happiness. And what's better than that? And of course, understanding economy and money, that's needed within your personal development. So gaining a solid understanding of how economy and money works can help you make better financial decisions. Like, learn what it means to burn money, the value behind it, and how important or not important it is. Like, you shouldn't be a person for whom money comes on the number one spot above everything. But to be honest, you also should not be a person for whom money comes on the last spot. And then what I would also like to say is, enjoy your youth. At the end of the day, don't forget to enjoy your youth. Don't be cheap. While saving money and investing is important, it's also crucial to spend money on things that make you happy. And of course, money cannot buy happiness, but you know what I mean. Life experiences. So, buying a thing, an object, most of the time will not make you happy, or only for a short while. But life experiences, so vacations. Don't miss out on memorable vacations with friends or family. Activities and hobbies. Engage in activities and hobbies that you enjoy. And of course, the social events and gatherings and stuff like that. So, unfortunately, we live in a world in which you need money to be able to do those things. And I don't know if it's really unfortunate, because I believe in hard work, and that hard work pays off. But hard is not hard in the sense of you have to break your body and everything to make money. Hard in the sense of you have to use your intellect and everything to be able to do it. So you really want to have the balance. Strive for balance between saving for the future and enjoying the present. You cannot go back to the past. All you have is now and later. So life is about experiences, and you don't want to miss out on those because you were too focused on saving every penny. It's not logical. Don't be a cheapskate. So in summary, I would like to say, investing is a crucial part of financial planning. From understanding inflation and the benefits of ETFs to exploring high-risk investments like options and the safety of gold, each investment type has its own pros and cons. Remember to only invest what you can afford. course, enjoy your youth and make sure to balance savings with living life to the fullest. It's once you get a bit in the world of finances and investing, you realize the things that your parents probably did or did not do to be where they are now. There are a lot of books on the finances and how money actually works. And there are a lot of people that have to work till they are 65, 70, and at the end of their life only have 1,000 or 2,000 bucks to spend. And others have a lot more to spend monthly. Sometimes I think that I didn't start investing on time, because the longer you invest, the more compounding there is. Compounding is a theory within itself, but it's like, how should I say it? I'm sorry, my nose is itching like crazy. Compounding is basically, if you invest, for example, 1,000 bucks this year in an ETF, a low risk ETF, and you get back 10%, just to round it up, you invested 1,000 bucks. At the end of the year, you have 1,100 bucks. If you reinvest and keep those 1,100 bucks, and the next year you get, and the following year you invest 1,000 more, then you get 10% of that back. So that's like 2,100 plus 10% is 2,310. So you keep investing, you keep getting back. So 1 year maybe you'll get minus 10%, but the year after you get 20%. So the average money you get back in ETFs is like the S&P 500 is 10% or something like that. There are a lot of calculators. Just for the fun of it, go to type in Google or whatever, S&P calculator, S&P 500 calculator, or all world calculator, or ETF calculator. Type in the money you invest initially, the money you would invest monthly. So let's say you invest $1,000 or euros at the start, and every month you invest 200 to 300, let's say 300 euros. And then it will ask you to type in how long you would invest. So let's say 20 years. It will calculate how much money from the start to the end you have invested, and how much money you will end up with, and the numbers are bizarre. So let's say you invest during your whole life, I don't know, 100,000. At the end of the investment period, so let's say 20 years, instead of the 100,000 on the bank, which you would have, potentially you would have, I think, like 300,000 or 400,000 or 500,000. So imagine making 400,000 bucks with that investment, which is a pretty safe investment, because I see it like this. I invest the money that I can spend, and if S&P 500, for example, goes down or something happens that it goes to zero, which is practically impossible. We as a human race have a much bigger problem if that happens, because something crazy happens if that manages to happen. We're like literally a fall of civilizations. And trust me, if that happens, you don't have to worry about the $300 you invested monthly. The younger you are, the more risk you can take. But I would say, I don't know, if you're 20, 18, 19, or however 21 to 25, doesn't matter. And I know at that age I didn't think about money in this way, or in investing in a S&P 500 or an all-world ETF. But you will be happy at the end of the ride that you did. And if you can buy one ETF every month for $90, just do it, man. Trust me, just do it. Do a little bit of research, or find someone in your family or circle of friends or internet of people who did start on time and how much money they end up with. For example, if you're 18 and you buy one ETF a month for the rest of your life, if my calculations are correct, you will have more money than a 40-year-old or 50-year-old who buys, I don't know, 50 ETFs every month or 500 ETFs for the rest of their life. So the younger you start, the more you will have at the end of the ride. And I know, as a young male or female, you don't think about what you will do when you're 50 or 60. But the more you think about it, the better it is. Live in the now, but don't forget the future you. The older you will be happy, the earlier you start investing, especially money that you don't really need right now. So yeah, basically that's it. Once again, I would really like to express my thanks to Phil with the name @ExcelSource7 for the $5 he donated on Buy Me a Coffee. I would greatly appreciate only a comment or a like or a subscription, but that really made my day, and he had a fine message also within that message, that giving me $5 is nothing compared to the value he got out of my videos. And also he talked about dividends, that it pays itself off. You shouldn't do everything for money, but you cannot deny that however you view money, it is an important part in our life. Also, to be honest, you shouldn't view money as a bad thing, because, for example, if I had 20 million, I don't want to put myself in these videos as a saint or something, but there are so many people, either the ones you know or the not know that you can make so happy with that money. Money doesn't buy happiness, but trust me, your mother, your best friend, would be extremely happy if you bought them a car or a house and you had the financial means to do that. The children's hospital, or I don't know, any what's that called in English? Like a donation to hospitals, to food banks, donation to people that are on the street. Like, imagine like going outside on the street and just seeing a homeless guy and asking him, "Hey man, what do you need? Do you need shirts? Do you need food, drinks? Tell me whatever you want," and you just buy something for 500 bucks for him, from food to new clothes, and then just leave and go away. I mean, that guy would feel like heaven, but you would also, I think, you would feel better for helping the person than the person himself. Because what's better, what feeling in life is better than making someone else happy? That's something to think about. Yeah, man. Yeah. So that's it about stocks. I'm sorry I got a bit philosophical at the end, but hey, it's my channel, right? And I made a poll, and in the next video I will talk about self-confidence, and the video after that it will be supplements that I use daily and also for fitness. Thank you for watching. Don't forget to like, comment and subscribe if you enjoyed the content. And a special thanks again to Phil for the donation. See you next time, guys. Stay wealthy, stay healthy. Bye bye.